Before we begin, a quick and important disclaimer. This video is for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. The concepts discussed, including the philosophy of risk management and the history of supplemental insurance products, are complex and subject to varying state laws and individual circumstances. The creator of this content is not a licensed insurance agent or legal professional. Insurance products involve specific terms, conditions, and exclusions that must be carefully reviewed. Viewers are strongly encouraged to conduct their own due diligence and consult with qualified professionals before making any decisions related to their personal finances or legal standing. Every 36 seconds in the United States, a legal contract is dissolved, often resulting in the single most significant financial catastrophe of an individual's life. We spend over $70 billion annually on the celebration of the Union, the flowers, the venues, the white dresses, but almost nothing on the statistical probability of its conclusion. Imagine a financial instrument so controversial that it was once labeled a wager against God, yet so pragmatic that it addresses a 40 to 50% statistical reality. This is the world of divorce insurance, a concept that sits at the volatile intersection of romantic idealism and cold, hard actuarial math. We are entering an era where the most intimate human connection is being reevaluated as a quantifiable liability. By the end of this deep dive, you will understand how the American economy has begun to monetize the risk of heartbreak, the philosophical shift required to treat a marriage like a capital asset, and why this specific financial evolution is the ultimate litmus test for the future of the American middle class. We are going to peel back the layers of the divorce industry, a machine that moves billions of dollars every year, to see if the unthinkable, insuring your love life, is actually the most rational thing a person can do in the 21st century. To understand why a product like divorce insurance even exists, we must first confront the philosophy of risk. In the American consciousness, we have been conditioned to insure almost every facet of our physical existence. We insure our homes against fires that have a less than 1% chance of occurring. We insure our vehicles against accidents, and we insure our lives to protect those we leave behind. Yet, when it comes to marriage, a venture with a historically documented failure rate that dwarfs almost any other insured risk, we rely almost entirely on hope. The philosophy of monetizing risk through divorce insurance is built on the premise that hope is not a financial strategy. In historical trends, we see that insurance has always followed the path of societal trauma. Marine insurance emerged because ships were sinking and ruining merchants. Life insurance emerged because the death of a breadwinner led to the poorhouse. Today, we see a trend where the financial dissolution of a marriage has become a leading cause of individual bankruptcy and a primary driver of downward mobility for children. The core problem this solves for the modern American is the mitigation of litigation poverty. When a marriage ends, the financial blow is twofold. There is the loss of shared assets and the immediate, staggering cost of the legal process itself. In many case studies, we see that the average cost of a contested divorce in the United States can range from $15,000 to over $30,000, and that is before a single asset is divided. For many, this represents their entire liquid net worth. Divorce insurance, or what some call marriage transition insurance, was designed as a casualty product to provide a cash benefit to cover these specific costs. It is not a payday, it is a hedge. Philosophically, it treats the end of a marriage not as a moral failure, but as a casualty event similar to a flood or a car wreck. This shift in perspective is radical because it removes the emotional stigma and replaces it with a systematic recovery plan. Historically, the American marriage was an economic unit of production. On a farm in the 19th century, a spouse was a business partner. As we transitioned into a consumer-based economy, marriage became a unit of consumption based on emotional fulfillment. This shift made the contract more fragile because fulfillment is harder to maintain than survival. As the contract became more fragile, the risk increased. However, the legal and financial tools available to the average person did not evolve at the same pace. For decades, the only real insurance against a bad split was the prenuptial agreement. But the prenuptial agreement has a high barrier to entry. It requires expensive lawyers up front, it is often seen as unromantic or adversarial, and it primarily protects what you already have rather than providing new capital to survive the transition. Divorce insurance attempted to democratize this protection. By paying a monthly premium, an individual could slowly build up units of coverage. If the marriage remained intact, the money stayed with the insurer, much like a term life policy. If the marriage ended, the policyholder received a lump sum to pay for legal fees, relocation, or basic living expenses during the transition. This is the monetization of risk in its purest form. It acknowledges that while no one enters a marriage expecting it to fail, the cost of that failure is too high for the average person to bear alone. We see in various historical trends that the middle class is the most vulnerable to this risk. The very wealthy have legal teams and trusts. The very poor often have fewer assets to litigate over. The middle class, however, often has just enough to lose everything in a protracted legal battle. The resistance to this concept is deeply rooted in what sociologists call the sacred versus profane divide. We want to believe that marriage is sacred, and therefore putting a price tag on its failure is profane. But the philosophy of this documentary argues that the profane reality of the legal system doesn't care about your sacred intentions. When you enter a courtroom, your marriage is a case number, and your assets are a spreadsheet. By looking at case studies of individuals who have navigated the family court system without a financial safety net, we see a recurring pattern of compounded trauma. The emotional trauma of the split is compounded by the financial trauma of debt. Furthermore, we must look at the marriage market through the lens of modern economics. In a world of no-fault divorce, the barrier to exiting a marriage is lower than it has ever been in human history. While this has provided necessary freedom and safety for many, it has also introduced a level of volatility that the old financial models cannot handle. When the risk of an event increases, the market typically responds with a product to hedge that risk. The fact that divorce insurance has struggled to find a foothold in the mainstream isn't due to a lack of demand, but rather a lack of cultural readiness. We are in a transitional period where we are starting to realize that "till death do us part" is a beautiful sentiment, but unless the court orders otherwise is the legal reality. This documentary series is a deep dive into that reality. We are going to examine the actuarial tables that determine how much a heartbreak is worth. We will look at the rise and fall of companies like Safeguard Guarantee, which attempted to bring this product to the American masses. We will explore the divorce industry complex, the lawyers, the mediators, and the experts who profit from the lack of insurance. Most importantly, we will ask the question: if we can insure against an act of God, why can't we insure against an act of man? This is about more than just money. It is about the evolution of the American family and the cold, calculated way we are learning to protect our futures in an increasingly uncertain world. We are moving past the era of "I hope it works" and into the era of "I hope it works, but I am prepared if it doesn't." That shift in mindset is the foundation of the modern philosophy of risk, and it is exactly what we are going to explore in the chapters to come. To understand the mechanics of monetizing heartbreak, we have to look past the emotions and into the cold, calculated spreadsheets of an actuarial scientist. In the year 2026, the data available to insurance underwriters has become more granular than ever before. When we talk about the philosophy of divorce insurance, we are talking about the application of the law of large numbers to the most volatile of human emotions. The law of large numbers suggests that while it is impossible to predict if one specific couple will stay together, it is entirely possible to predict how many couples out of a million will separate within a specific time frame. This is where the monetization begins. Imagine a citizen named John, a 38-year-old middle manager living in Columbus, Ohio. In 2026, John represents the typical target demographic for these financial instruments. He has a stable career, a mortgage, and 2 children. John is not planning on a divorce. In fact, he is happily married. However, John is also a student of historical trends. He knows that in the United States, the probability of a first marriage ending is approximately 40%, and for a second marriage, that risk climbs even higher. John views his marriage not just as a romantic bond, but as a significant financial exposure. If his marriage were to dissolve, the potential outcomes include the liquidation of his retirement accounts, a forced sale of his home, and a decade of alimony payments that could total hundreds of thousands of dollars. For John, divorce insurance is a way to hedge against this casualty. In the insurance industry, a casualty is defined as an accident or an unfortunate occurrence. By categorizing divorce as a casualty rather than a moral failing, the industry removes the stigma and replaces it with a premium. The philosophy here is that risk is a commodity that can be traded. John pays a monthly premium, let us say $75, to an insurance provider. In exchange, the provider assumes the financial risk of his marriage failing. If John and his wife reach their 20th anniversary, the insurance company has successfully collected premiums for 2 decades without a payout, which is their ideal scenario. But if the marriage dissolves after 10 years, John receives a cash benefit designed to mitigate the transition costs. This brings us to a critical concept in the philosophy of risk: adverse selection. This is the primary reason why divorce insurance has not yet become as ubiquitous as auto insurance. Adverse selection occurs when those most likely to experience a loss are the ones most likely to buy the insurance. If only people in failing marriages buy divorce insurance, the system collapses because the payouts will always exceed the premiums collected. To solve this, insurance models in 2026 utilize mandatory waiting periods. Most policies in this sector require a minimum of 48 months of premium payments before a claim can be filed. This ensures that the policyholder is not purchasing the insurance with the immediate intent to divorce. It forces the risk to be spread out over a longer timeline, making the pool of insured individuals more stable. Consider the step-by-step process of how this risk is priced. An underwriter in 2026 does not just look at John's age. They look at the socioeconomic volatility of his geographic region. They look at the divorce laws of Ohio compared to a state like California. In a community property state, where assets are split 50-50 regardless of circumstances, the financial risk to a high earner is significantly higher than in an equitable distribution state. The insurance company must calculate the potential outcomes of a legal battle in John's specific jurisdiction. They analyze historical trends of legal fees in Columbus. They factor in the average cost of a child custody evaluator and the price of a forensic accountant. All of these variables are bundled into a single monthly premium. Now, let us look at the philosophy of the moral hazard. This is one of the most significant arguments against the monetization of divorce. Moral hazard is the idea that when you are insured against a risk, you are less likely to take steps to avoid that risk. In the context of John, critics would ask, if John knows he has a $50,000 payout waiting for him if his marriage ends, will he work as hard to save it during a difficult year? Will he invest in marriage counseling? Or will he see the insurance payout as an easy exit? The counterargument, and the one gaining traction in 2026, is that financial stress is actually one of the leading causes of divorce. By providing a financial safety net, the insurance might actually reduce the pressure on a struggling couple, potentially leading to better outcomes. This suggests that the monetization of the risk could, paradoxically, stabilize the institution it is insuring. We also need to examine the concept of the marriage transition benefit. Unlike life insurance, which pays out upon a definitive event like death, divorce insurance often operates on a tiered benefit system. In 2026, these policies are frequently structured as units of coverage. John might buy 10 units of coverage. Each unit provides a specific amount of liquidity for different phases of the divorce process. Unit 1 might cover the initial legal retainer. Unit 2 might cover the cost of a private mediator. Unit 3 might be specifically earmarked for relocation expenses. This granular approach allows the insurance company to manage their payouts while providing John with a structured recovery plan. Case studies from the early 2020s showed that the lack of immediate liquidity was the primary factor that forced individuals into unfavorable legal settlements. When one spouse controls the liquid assets and the other does not, the spouse without funds is often forced to settle for pennies on the dollar just to end the litigation. Divorce insurance flips this script, provides what is known as litigation capital. By having an independent source of funds, an individual like John is not forced into a corner by financial desperation. This changes the entire power dynamic of the American legal system. It moves the process away from a war of attrition and toward a more balanced negotiation. But what happens to the money if the divorce never happens? This is where the philosophy of risk monetization takes a turn toward the long-term investment. Some models in 2026 experiment with a return of premium rider. If John stays married for 25 years, he might receive a portion of his premiums back, or the policy might convert into a long-term care product. This creates a win-win scenario for the insurer and the insured. The insurer gets to hold and invest John's premiums for decades, and John gets a safety net that serves a dual purpose. This is the deep dive into the machinery of modern risk. We are seeing the transformation of a personal tragedy into a predictable, manageable expense. We are witnessing the birth of a world where love is the variable, but the cost of its end is a constant. We are beginning to treat the family unit with the same level of financial sophistication that we treat a corporate merger. However, this raises a haunting question about the nature of our social fabric. If we have successfully quantified the cost of a broken heart, have we also inadvertently set a price on the incentive to stay? As we move forward, we have to ask, who really wins in this system? Is it the policyholder who gains peace of mind? Or is it a new breed of financial titans who have found a way to profit from the instability of the American home? And what happens when these insurance companies start using their massive data sets to influence who we marry in the first place? In the next part, we will go inside the secretive world of the data brokers who are selling your relationship history to the highest bidder to determine your premium. We will uncover how your social media interactions and your digital footprint are being used to predict the exact date your marriage might fail. This is the dark side of the data, and it is a rabbit hole that goes much deeper than any insurance policy. In the landscape of 2026, the concept of a private life has largely become a digital myth, especially when it comes to the actuarial precision of the insurance industry. To monetize the risk of divorce, companies have moved beyond simple questionnaires. They have tapped into the vast ocean of behavioral data that every American generates every second of the day. This is the birth of the Predictive Divorce Index, or PDI. It is a score, much like a credit score, that represents the statistical likelihood of your domestic contract reaching a terminal point within the next 5 to 10 years. Imagine Sarah, a 32-year-old software engineer living in Seattle. In 2026, Sarah is looking to protect her assets as she enters her first marriage. She applies for a divorce insurance policy, expecting a standard premium. However, the underwriter's algorithm returns a high-risk rating. Sarah's confused. She and her partner have never had a public argument. They share a beautiful home, and their social media profiles are filled with images of domestic bliss. But the algorithm sees what the human eye ignores. It has analyzed Sarah's digital footprint through data brokers who specialize in relationship stability metrics. The first layer of this data harvesting is financial synchronization. In historical trends, one of the most accurate predictors of marital dissolution is not the amount of money a couple has, but the divergence in their spending patterns. The algorithm tracks Sarah's individual credit card transactions against her partner's. It notices that over the last 18 months, their discretionary spending has become increasingly siloed. They are no longer making large joint purchases for the home. Instead, Sarah is spending more on solo travel and independent hobbies, while her partner is investing heavily in a separate brokerage account. To a human, this might look like healthy independence. To an insurance algorithm in 2026, this is a signal of decoupling. It is a precursor to the financial separation that precedes a legal one. Next, the analysis moves to the sentiment of their digital communications. This is where natural language processing, or NLP, becomes a tool for risk monetization. Insurance companies in 2026 often purchase access to metadata from communication platforms. They aren't reading Sarah's private messages word for word, but they are analyzing the frequency, timing, and emotional tone of the interactions. Historical trends show that as a relationship nears a breaking point, the latency in response times between partners increases. The language shifts from the inclusive we and us to the individual I and me. The algorithm flags a 30% decrease in digital interaction during evening hours over the last quarter. This metadata suggests a lack of co-presence, a metric that carries significant weight in determining a PDI score. The depth of this surveillance extends even to the physical world through geolocation data. By 2026, the average American's movements are tracked with sub-meter accuracy via their smartphones and connected vehicles. The underwriter looks at the time Sarah spends at her primary residence versus her time spent at third places, cafes, gyms, or secondary properties. A shift in the ratio of time spent together in the home is a major actuarial red flag. If the geolocation data shows that Sarah and her partner are consistently in the same house, but in separate rooms for 80% of their waking hours, the algorithm categorizes this as a functional separation. This is the monetization of the silent divorce, where the risk of illegal filing is high even if the public facade remains intact. We must also consider the role of the big data brokers, the invisible architects of this new economy. Companies like Axiom and LexisNexis have evolved to offer specialized marital risk reports. These reports aggregate data from public records, such as lawsuits, tax liens, and even the frequency of address changes, and combine them with private behavioral data like browser history and app usage. If Sarah starts searching for individual apartment rentals or visiting websites for family law attorneys, her PDI score fluctuates in real time. In the world of 2026, your search bar is a window into your future legal liabilities. This leads us to a fundamental philosophical shift: the transition from reactive insurance to predictive intervention. Some insurance providers in 2026 have begun offering premium discounts if the couple agrees to use a relationship tracking app. These apps use biofeedback from wearable devices to detect physiological stress during conversations. If the app detects a spike in cortisol levels during a discussion about finances, it might suggest a cooling-off period or provide a prompt for a mediated conversation. The insurance company isn't doing this out of the goodness of their heart. They are doing it to mitigate their own risk. Every divorce they can prevent or delay is a win for their bottom line. However, this creates a profound ethical dilemma. When we quantify the risk of a relationship, we inherently change the nature of that relationship. This is known as the observer effect in social science. If Sarah knows her premium will increase if she spends too much time away from home, she might stay home not out of love, but out of financial necessity. We are seeing the emergence of a marriage surveillance state, where the incentives of the insurance industry begin to dictate the behavior of the American family. The monetization of risk is effectively creating a new form of social control. Consider the case study of a high-net-worth individual in New York City who was denied coverage altogether in early 2026. The reason? The algorithm discovered a pattern of serial transition in his social circle. By analyzing his contact list and social media connections, the AI determined that 60% of his closest friends had divorced within the last 3 years. Social contagion is a real factor in actuarial science. If your peer group views divorce as a standard life transition, you are statistically more likely to follow suit. The insurance company viewed his social environment as a toxic asset. This is a level of discrimination that was once reserved for health insurance and pre-existing conditions, now applied to the most intimate parts of our social lives. Step by step, the underwriting process for divorce insurance has become a comprehensive audit of the human experience. It starts with the financial, moves through the digital, and ends with the biological and social. For the American consumer in 2026, the price of protecting your future is the total surrender of your privacy. You are no longer just a spouse. You are a collection of data points, a walking liability that must be hedged, traded, and optimized. But as these algorithms become more powerful, they also become more opaque. Sarah has no way of knowing exactly which data point caused her premium to spike. Is it her travel habits? Her late-night Google searches? Or the fact that her best friend just filed for separation? This black box of marital risk means that the insurance companies now hold a terrifying amount of power over the American middle class. They have the power to validate a marriage or to signal its doom before the couple even realizes there is a problem. The implications of this are staggering. If an insurance company can predict the end of a marriage with 90% accuracy, does the legal system have a right to that information? Can a PDI score be used as evidence in a custody battle? We are approaching a tipping point where the monetization of risk through insurance is about to collide with the American legal system in a way that will redefine the concept of justice. As we look at the rise of this data-driven industry, we have to wonder what happens when the data is used not just to price a policy, but to actively dismantle a marriage. In the next part, we will explore the divorce tech revolution, the apps and platforms specifically designed to make the process of separating so efficient and low cost that they actually increase the divorce rate. We will look at how the same companies insuring the risk are often the ones funding the technology that makes the risk more likely to materialize. We are entering the world of the auto divorce, and the consequences for the American economy are more explosive than you can imagine. The transition from predicting a divorce to executing one is where the philosophy of monetization meets the cold reality of software engineering. By the year 2026, the traditional image of two lawyers in a wood-paneled office arguing over a mahogany desk has been replaced by a clean white user interface on a smartphone. This is the era of frictionless litigation, a term that sounds like a contradiction, but has become a multi-billion-dollar subsector of the American economy. The goal of this technology is simple: to remove the human element, and thus the human cost, from the dissolution of a marriage. Imagine Michael, a 45-year-old architect living in the tech-heavy corridor of Austin, Texas. In early 2026, Michael and his spouse have reached a point where the predictive analytics on their shared insurance dashboard have been flashing amber for 6 months. Instead of the shock and vitriol that defined divorces in the 1990s, Michael experiences a sequence of automated events. The insurance provider, which has been collecting Michael's premiums for 8 years, realizes that a claim is likely. In a move of strategic vertical integration, the insurer does not wait for a lawsuit to be filed. Instead, they provide Michael with a complimentary subscription to an AI-driven mediation platform. This is the philosophy of cost containment in action. If the insurance company is on the hook for a $50,000 payout to cover legal fees, their primary objective is to ensure those legal fees never actually materialize. Michael's experience with the auto divorce platform begins with asset synchronization. In 2026, the concept of hiding assets is virtually impossible for the middle class. The platform connects directly to Michael's bank accounts, his brokerage firm, the title registry for his Austin home, and even the digital wallets holding his various cryptocurrencies. Step by step, the software creates a perfect, real-time balance sheet of the marriage. There is no discovery phase, no expensive forensic accountants, and no room for debate. The algorithm applies the equitable distribution laws of Texas to the spreadsheet with a precision that no human judge could match. This leads to the implementation of the Nash equilibrium in asset division. The software doesn't just split the value, it negotiates. It asks Michael and his spouse to rank the importance of various assets: the house, the retirement fund, the art collection. The AI then runs thousands of simulations to find the one outcome where both parties achieve their highest possible utility score. This is the monetization of peace. By removing the emotional leverage from the negotiation, the platform reduces the time to reach an agreement from 18 months to 18 hours. For the insurance company, this efficiency is the ultimate victory. They have successfully minimized the casualty event they were insuring against. However, the economic ripples of this frictionless exit extend far beyond the couple's living room. We must look at the Austin housing market as a case study for the macroeconomic impact of divorce tech historically. A divorce meant a slow, painful sale of the family home, often taking 6 to 9 months. In 2026, the auto divorce platform is integrated with institutional real estate buyers. The moment the AI-mediated settlement is signed digitally, an offer is generated based on current market data. The home is sold, the mortgage is settled, and the equity is distributed to the respective parties in a matter of days. While this provides Michael with the liquidity he needs to start his new life, it also contributes to a more volatile housing market. When the friction is removed, the velocity of housing turnover increases. Divorce, once a slow-moving tragedy, has become a high-frequency financial transaction. This brings us to the profound philosophical conflict at the heart of this industry: the incentive structure of the insurance companies themselves. In historical trends, we see that when a company insures a risk, they usually want to prevent that risk from happening. But in 2026, many insurance conglomerates also own the very platforms that make divorcing easy and efficient. This creates a feedback loop. By lowering the cost and the emotional barrier to exit, the technology potentially increases the frequency of the event. If a divorce is as easy as unsubscribing from a streaming service, more people will choose that path. The insurance company loses on the claim payout, but they win on the transaction fees, the data harvesting, and the referral fees from the real estate and relocation services integrated into their platform. They have monetized the entire life cycle of the relationship's end. Furthermore, we must examine the concept of the social hazard. In the early 2000s, researchers often discussed the divorce gap, the significant drop in standard of living that women, in particular, faced after a split. The proponents of 2026 divorce tech argue that their platforms close this gap by ensuring a fair and rapid distribution of resources. But critics argue that they are ignoring the psychological cost of speed. When Michael can finalize his divorce during his lunch break, he loses the cooling-off period that the old, slow legal system accidentally provided. The friction of the law served as a final barrier that saved many marriages. By removing that friction, we are treating human relationships like disposable assets. We are optimizing for liquidity at the expense of stability. The data supports this concern. In metropolitan areas where auto divorce platforms have a high penetration rate, we see a 10% increase in short-term marriages, those lasting fewer than 5 years. The ease of the exit has become a factor in the decision to enter the contract. This is the ultimate monetization of risk. The risk has been so thoroughly managed, hedged, and automated that it no longer feels like a risk at all. Feels like an administrative task. But what happens when the algorithm makes a mistake? What happens when Michael realizes 3 months later that the AI's ranking of his emotional utility for the family dog was fundamentally flawed? In the frictionless world of 2026, there is no appeal process for an automated settlement that you signed with a thumbprint. The speed that provided the liquidity also stripped away the legal safeguards of due process. The American middle class is trading their constitutional right to a day in court for the convenience of an app and a faster insurance check. As we go deeper into this documentary, we have to look at how this philosophy is changing the very nature of American childhood. If the parents' relationship is an asset to be managed and liquidated, what does that make the children? We are moving into a territory where custody algorithms are being used to determine the exact number of hours a child spends in each household to maximize parental performance metrics. We are about to see how the monetization of risk has moved from the bank account to the nursery. In the next part, we will explore the terrifying rise of child support futures. We will uncover how investors are now betting on the future earnings of children from divorced households, and how your insurance premium is being linked to your child's GPA. We will meet the Wall Street analysts who view your custody battle as a high-yield investment opportunity. This is where the philosophy of insurance turns into a predatory market, and the stakes are no longer just your bank account, they are the future of the next generation. We are entering the world of the securitized family, and the implications will change everything you thought you knew about the American dream. The securitization of the American family is not a distant dystopian fantasy, but a functional reality in the fiscal landscape of 2026. To understand the depth of this philosophy, we must look at how the financial markets have begun to treat child support in custody as a form of high-yield debt. Historically, child support was a simple transfer of wealth from one parent to another, regulated by the state and often fraught with collection issues. In 2026, the monetization of this risk has evolved into what Wall Street analysts call the parental performance bond. This is the ultimate expression of the securitized family, where the future potential of a child is used to hedge the immediate financial fallout of a divorce. Imagine a citizen named David, a 42-year-old specialized surgeon living in Chicago. David is undergoing a divorce in early 2026. Under the traditional system, David would be ordered to pay a fixed monthly sum for the next 12 years. However, in the 2026 economy, David's divorce insurance policy includes a human capital rider. The insurance company, looking at historical trends, knows that the greatest risk to their bottom line is a default on these payments or a protracted legal battle over their amount. To mitigate this, they have facilitated the creation of a child support escrow bond. David's future payments, which are legally mandated and virtually certain to be paid given his high-earning profession, are bundled with thousands of other similar obligations and sold to institutional investors. For David, this means his child support is essentially prepaid by the investors. The insurance company uses the capital from the bond sale to create a liquid trust for his children. This removes the monthly friction between David and his ex-spouse, but it introduces a new, cold oversight. Because investors now have a stake in the cash flow, they require data on the performance of the asset. In this case, the asset is David's daughter, Emily. This brings us to the most controversial layer of the monetization of risk, the GPA-linked premium. In 2026, insurance underwriters have identified a direct correlation between a child's academic performance and the long-term stability of the post-divorce financial arrangement. Case studies have shown that when children from divorced households maintain high academic standards, the likelihood of the parents re-entering the legal system for additional support or modifications decreases by nearly 60%. Therefore, Emily's school portal is directly linked to David's insurance dashboard. If Emily's GPA remains above a 3.7, David receives a performance credit on his premiums. If her grades slip, the algorithm views this as a signal of domestic instability, a precursor to a potential legal claim, and his rates increase in real time. This is the philosophy of human capital underwriting. It treats parenting not as a private emotional journey, but as a quantifiable management task with measurable outputs. The insurance company is essentially betting on Emily's future success to offset the current risk of David's divorce. If Emily is successful, she represents a lower multi-generational risk. If she struggles, she represents a potential future liability for the state and the insurance pool. By linking the cost of the insurance to the performance of the child, the industry creates a powerful, albeit cold, financial incentive for what they call optimal parenting. Now, consider the perspective of the Wall Street analysts who are driving this market. In 2026, firms like BlackRock and Vanguard have dedicated departments for social contract securities. They view a divorce not as a tragedy, but as a restructuring of a small corporation. They look for custody efficiency metrics. They analyze historical trends to determine which custody arrangements, week on week off versus 2-2-3 splits, result in the highest parental productivity and the lowest child-related expenses. Step by step, the lives of David and Emily are being optimized for the benefit of the bondholders. The time Emily spends with David is no longer just about bonding. It is about maintaining the performance metrics required by the trust. Imagine a scenario where the algorithm detects that David's productivity at the hospital drops by 15% during his weeks with Emily. In the world of 2026, his divorce insurance provider might send an automated recommendation to hire a specialized, AI-vetted tutor or nanny, even offering a microloan to cover the cost. The insurer isn't doing this for Emily's well-being. They are doing it to protect David's income stream, which serves as the collateral for the bonds they have sold. This is the monetization of the nursery. Every hour of a child's life is being scrutinized for its economic utility. The macroeconomic implications of the securitized family are staggering. When you bundle child support into bonds, you create a massive, stable asset class that is insulated from the volatility of the stock market. People may stop buying iPhones, but they rarely stop being legally obligated to their children. This has led to the emergence of what analysts call the divorce yield. In 2026, pension funds and sovereign wealth funds are increasingly looking to these parental performance bonds as a safe haven for capital. This means that your local teacher's pension might be partially funded by the interest collected from David's divorce settlement. The American dream has been inverted. Instead of the family building wealth for the future, the family's dissolution has become a source of wealth for the global financial system. However, this creates a profound ethical vacuum. When we treat children as the collateral for insurance products, we are fundamentally changing the social contract. In historical trends, the state was the ultimate arbiter of a child's best interest. In 2026, that role is being usurped by the underwriter. If a child's best interest conflicts with the performance metrics of the bond, who wins? If David wants Emily to pursue a degree in the arts, but the insurer's data shows that a STEM path reduces the risk of future financial dependency by 80%, the pressure on David to influence Emily's choice becomes a matter of his own financial survival. We are seeing the rise of the specialized consultant class, family optimization officers, who help parents like David navigate these algorithmic requirements. They provide advice on how to gamify the custody schedule to trigger premium discounts. They teach parents how to use wearable technology to prove they are engaging in high-value interactions with their children, which can lower their risk score. This is a far cry from the emotional support once provided by family therapists. It is a technical audit of the soul. As we peel back the layers of this securitized world, we have to confront the reality that for the American middle class in 2026, the family has become a franchise. You pay your fees, you follow the operating manual provided by your insurer, and you hope that your performance metrics stay within the green zone. The philosophy of monetizing risk has reached its logical, and perhaps most terrifying conclusion. We have moved past insuring against the end of a marriage, and into the territory of managing the aftermath as a permanent, profitable enterprise. But as the financial world becomes more obsessed with these parental bonds, a new and even more radical shift is occurring on the edges of the economy. If we can securitize the failure of a marriage, what happens when we start to treat the alimony itself as an equity stake? What happens when your ex-spouse is no longer just a former partner, but a permanent shareholder in your future career? In the next part, we will explore the rise of career equity alimony, where the divorce settlement gives your ex-spouse a literal percentage of your future promotions and bonuses, and how these stakes are being traded on secondary markets. We are about to enter the world of the lifetime liability, and the way it is changing the American workplace will make you question the very definition of professional freedom. The evolution of the American divorce settlement has reached its most sophisticated, and perhaps its most chilling stage: the birth of career equity alimony. By the year 2026, the traditional model of a fixed monthly payment has been largely discarded by high net worth, and even upper middle class families, in favor of a dynamic, performance-based equity stake in a former partner's future. This is the philosophy of the lifetime liability. It treats the professional trajectory of a spouse as a capital asset that was developed during the marriage, and therefore, the non-earning or lower-earning spouse is entitled to a literal percentage of that asset's future yield. Imagine Jessica, a 36-year-old senior vice president at a major pharmaceutical firm in New Jersey. In 2026, Jessica is the primary breadwinner, having climbed the corporate ladder while her spouse managed the household and supported her through an MBA program. When their marriage dissolved 2 years ago, the court did not simply order Jessica to pay $5,000 a month. Instead, her ex-spouse's legal team negotiated for a 15% equity stake in Jessica's total compensation for the next 10 years. This is not just a percentage of her current salary. It is a percentage of every promotion, every performance bonus, every stock option grant, and every signing bonus she might receive if she switches companies. Step by step, the technology of 2026 makes this arrangement seamless and unavoidable. Jessica's payroll department is integrated with a specialized fintech platform designed for matrimonial equity management. Every time Jessica receives a paycheck or a vestment of restricted stock units, the algorithm automatically bifurcates the funds. 15% is diverted instantly to a trust account before Jessica even sees it in her primary bank account. This is the monetization of professional potential. Historically, alimony was meant to maintain the recipient's standard of living until they could become self-sufficient. In the 2026 philosophy, alimony is viewed as a dividend on a past investment. This shift has created a massive secondary market for what are now called alimony-backed securities. Consider the financial reality of Jessica's ex-spouse. While he has a 15% stake in a high-performing executive, he might need immediate liquidity to purchase a home or start a business. In 2026, he doesn't have to wait 10 years to collect his share. He can go to a platform like Settlement Exchange and sell his equity stake to institutional investors. A hedge fund in Manhattan might look at Jessica's career metrics, her historical trends of promotion, her industry's growth rate, and even her health data, and decide that her future earnings are a buy. They pay the ex-spouse a lump sum today, and in exchange, they become the owners of that 15% stake in Jessica's career. Jessica is no longer just working for herself, her children, or even her ex-spouse. She is working for a group of anonymous investors who view her professional output as a line item in a diversified portfolio. This leads to a profound psychological and professional crisis that many Americans are facing in 2026, the motivation paradox. If Jessica knows that a significant portion of her hard-earned bonuses will be siphoned off to investors who have no connection to her life, does she still strive for that next promotion? Case studies from this era show a rising trend of performance plateauing, where individuals with high equity leakage intentionally stay at their current level of seniority to avoid the increased stress of a role where they only keep a fraction of the incremental gain. This has forced corporate America to change how it manages talent. In 2026, HR departments at major firms like Jessica's now include equity leakage analysts. When the company is considering a high-level hire, they don't just look at the candidate's resume. They look at their matrimonial equity obligations. If a candidate like Jessica is leaking 20 or 30% of her incentives to a competitor's hedge fund, the company views her as a flight risk or a motivation risk. Why would the company give her $1 million retention bonus if $300,000 of that goes directly to a third-party investor? This is the creation of a new glass ceiling of debt that is specific to the divorced American professional. The philosophy of monetizing risk has effectively turned the American workplace into a theater for post-marital financial warfare. We are seeing cases where activist investors, who hold stakes in several executives within the same industry, attempt to influence corporate culture or hiring practices to maximize the yield of their alimony bonds. This is the ultimate expression of the commodification of the individual. In this world, professional freedom is an illusion. You are tethered to your past in a way that is mathematically precise and legally enforceable. Furthermore, we must examine the impact on career choices and innovation. Historically, the United States has been a land of professional risk-taking, leaving a stable job to start a company. But for someone like Jessica, who is under a lifetime liability contract, taking a pay cut to join a startup is a legal nightmare. Her equity holders might sue her for intentional underemployment or waste of asset. They have a vested interest in her staying in the highest-paying, most stable role possible, regardless of her personal fulfillment or professional growth. The insurance companies that once protected against the risk of divorce have now evolved into the gatekeepers of professional mobility. By 2026, we see that the monetization of divorce has moved from a safety net to a cage. We have successfully mitigated the immediate financial shock of a split, but we have replaced it with a permanent state of professional indentured servitude. The data shows that this system has increased the total wealth of the financial sector, but it has decreased the overall career satisfaction scores of the American workforce to historic lows. We are living in a society where your ex-spouse's shadow follows you into every boardroom and every performance review. But as oppressive as this system sounds, there is a subculture emerging in 2026 that is trying to hack the algorithm. A new movement of strategic decouplers is finding ways to use the very technology that tracks them to create a different kind of freedom. They are exploring the ghost economy of divorce, where assets and income are hidden not in offshore banks, but in decentralized autonomous organizations and synthetic identities. This is a high-stakes game of digital cat and mouse that is threatening to blow a hole in the entire divorce insurance industry. In the next part, we will go deep into the world of the shadow settlement. We will uncover how the most tech-savvy Americans are using blockchain and deepfake technology to disappear from the actuarial maps of their insurance providers. We will explore the rise of identity hedging, where individuals create entire digital lives to mask their true income from the equity holders. We are about to enter the underground of the divorce industry, where the battle for financial survival has moved into the dark corners of the internet. This is the era of the invisible divorce, and it is the only way some people believe they can truly ever be free again. The emergence of the shadow settlement is the inevitable reaction to a world where every heartbeat and every dollar is quantified by an insurance underwriter. In 2026, the American middle class is beginning to realize that if you cannot change the rules of the game, you simply stop playing by them in a way the system can see. This has given rise to a sophisticated underground economy designed to bypass the prying eyes of the divorce insurance industry. We are witnessing a high-stakes digital insurgency where the objective is not to win the divorce, but to disappear from the actuarial map entirely. Imagine Marcus, a 40-year-old software architect living in the suburbs of San Jose. In the eyes of his divorce insurance provider and the holders of his career equity bonds, Marcus is a cautionary tale of professional decline. According to the official records in 2026, Marcus suffered a mental health crisis shortly after his divorce was finalized, leading him to quit his $300,000 a year job to work as a part-time freelance consultant earning a fraction of his previous income. To the insurance company, the potential outcomes for Marcus's career equity stakes have plummeted, and his ex-spouse's investors are preparing to write off a significant portion of their expected yield. But in reality, Marcus is thriving. He is a primary architect of the ghost economy, while his official identity, his social security number and his primary bank accounts, shows a state of near poverty. His true professional life exists within a decentralized autonomous organization, or DAO, based on a sovereign cloud server outside of traditional U.S. jurisdiction. Marcus is being paid in stablecoins, his income shielded by zero-knowledge proofs that allow him to prove he has the funds to pay his mortgage without revealing the source, the amount, or the frequency of his earnings. This is the philosophy of the invisible divorce, the strategic decoupling of one's legal identity from one's economic reality. The mechanics of this shadow settlement are incredibly complex and involve a step-by-step process of digital obfuscation. First, an individual like Marcus must create a synthetic identity. This is not a simple fake ID. It is a fully fleshed-out digital persona with its own credit history, social media presence, and professional footprint. In the 2026 underground, there are services that specialize in incubating these identities for years before they are needed. By the time Marcus quits his job, his synthetic identity has already been working in the shadow economy for 36 months. Next, the individual must navigate the minefield of lifestyle forensics. As we discussed earlier, insurance companies in 2026 don't just look at bank statements, they look at digital exhaust. If Marcus claims to be earning $40,000 a year but his smart home is consuming enough electricity to power a high-end server rack, or if his grocery delivery app shows he is still purchasing organic Wagyu beef and vintage Bordeaux, the algorithm will flag him for an audit. To counter this, Marcus uses lifestyle masking protocols. He has programmed his smart home to simulate the energy signature of a low-income household. He uses peer-to-peer delivery networks where transactions are settled in cash or anonymous digital tokens. He is living a double life where his physical reality is luxury, but his digital footprint is austerity. However, the insurance industry is not sitting idly by. In 2026, the largest providers have established what they call actuarial bounty hunter units. These are specialized teams of AI-driven private investigators whose sole job is to find the missing income of high-value policyholders. They use advanced pattern recognition to link Marcus's synthetic identity back to his biological one. They look for microbehaviors that are unique to Marcus, the specific way he types, the syntax of his code, or the idiosyncratic routes he takes when he goes for a morning run. Historical trends show that even the most careful individuals eventually leave a biological signature in the digital world. Case studies from early 2026 show that these bounty hunters are now using satellite imagery and IoT sensor data to track lifestyle anomalies from orbit. If a person in a lower middle-class neighborhood is consistently seen driving a vehicle that is not registered to them, or if their backyard pool is heated to 85 degrees in the middle of a Chicago winter, The insurance company will file a discovery of concealed assets motion in a digital court. The war between the decouplers and the underwriters has turned the American suburb into a battlefield of surveillance and counter-surveillance. Furthermore, we must explore the philosophy of the trustless marriage. This is a movement of younger Americans, primarily in the tech and finance sectors, who are rejecting traditional marriage and divorce insurance altogether in favor of smart contract-based unions. In a trustless marriage, there is no state-issued license and no insurance policy. Instead, the couple's assets are held in a multi-signature wallet. The terms of their divorce, the division of assets, the custody schedule, and the support payments are hard-coded into the contract from day one. If the kill switch is triggered by both parties, or by a predetermined set of conditions, the contract executes automatically. There is no litigation, no discovery, and no room for insurance companies to monetize the risk. The risk is self-managed and self-executing. This movement is a direct threat to the multi-billion-dollar divorce insurance complex. If the American public moves towards self-executing contracts, the entire industry of risk monetization collapses. In 2026, we are seeing a massive lobbying effort by the insurance giants to have these trustless marriages declared illegal or taxable as corporate entities. They argue that these contracts bypass the protective oversight of the family court system and create a shadow society that is unaccountable to the state. But the proponents of the ghost economy argue that they are simply reclaiming the privacy and agency that the insurance industry stole from them. The stakes of this conflict are reaching a fever pitch. For Marcus, the risk of being caught is not just financial. It is a form of social death. In 2026, if you are found guilty of insurance fraud or asset concealment in a matrimonial case, your PDI score doesn't just go down, it is blacklisted. You become uninsurable in every category, from health to auto to life. You are effectively barred from the formal economy. This is the ultimate deterrent used by the industry, the threat of total digital excommunication. As we look at the battle lines being drawn, we realize that the monetization of risk has created a world where honesty is a liability and transparency is a trap. The American family, once the bedrock of social stability, has become a site of deep cover operations and forensic warfare. We have reached a point where the only way to protect your future is to hide it. But even as individuals like Marcus find ways to slip through the cracks, a much larger and more powerful force is preparing to intervene. The U.S. government, watching the massive profits of the insurance industry and the rising chaos of the shadow economy, is about to make a move that will change everything. They are no longer content to let private companies manage the risk of the American social contract. They are preparing to nationalize it. In the next part, we will explore the secret legislative battle over the social stability tax. We will uncover the government's plan to replace private divorce insurance with a mandatory, state-run relationship social security system. We will look at how this plan would involve a universal relationship score for every American citizen, and how it could lead to the most invasive form of government overreach in U.S. history. We are about to enter the era of the state-sponsored marriage, and the implications for your freedom of choice are more radical than anything we have discussed so far. This is the endgame of the monetization of risk, and it is closer than you think. The transition from private risk management to state-mandated stability began as a quiet legislative ripple in the summer of 2025 and has, by early 2026, become the dominant fiscal reality for every American household. This is the era of the social stability tax, a mandatory payroll deduction that has effectively nationalized the concept of divorce insurance. The United States government, observing the massive capital flight into the shadow settlements of the ghost economy and the systemic risk posed by the volatility of the American family unit, decided that the management of human relationships was too important to be left to the whims of the private market. The philosophy shifted from the individual's right to hedge their own risk to the state's duty to ensure the collective equilibrium of the population. Imagine Robert, a 29-year-old accountant living in Atlanta, Georgia. It is March 2026, and Robert is preparing to file his taxes. For the first time, he sees a new line item on his Form 1040, the Domestic Vulnerability Assessment. This is not a voluntary insurance premium like the ones John or Sarah paid in earlier years. This is a federal levy, a percentage of Robert's gross income that goes into the National Family Resilience Fund. The logic provided by the newly formed Department of Domestic Equilibrium is purely mathematical. Historical trends indicate that a single divorce costs the American taxpayer an average of $120,000 in lost productivity, social service interventions, and judicial overhead. In the eyes of the state, an unstable marriage is a public nuisance and a fiscal liability. To manage this liability, the government has introduced the Universal Relationship Score, or URS. If the PDI of the private sector was a warning, the URS is a mandate. It is a 3-digit number, ranging from 300 to 850, that determines Robert's eligibility for everything from federally backed mortgages to small business administration loans. Robert's URS is not just a reflection of his own behavior. It is a composite score of his compatibility with his current partner. In 2026, when Robert and his fiancée apply for a marriage license in Fulton County, they are not just signing a contract, they are undergoing a mandatory algorithmic audit. Step by step, the URS calculation process is more invasive than any private background check in history. The Department of Domestic Equilibrium pulls data from the Internal Revenue Service, the Department of Education, and even the Department of Motor Vehicles. They look for what sociologists call high-velocity life events. Has Robert moved more than 3 times in 5 years? Has his partner changed jobs frequently? Does their combined debt-to-income ratio suggest a future of financial friction? If the algorithm determines that their union has a high probability of failure, their URS is lowered. A lower score translates directly into a higher social stability tax rate. Robert is literally being taxed on the perceived fragility of his love life. This is the philosophy of relationship redlining. Just as banks once denied loans based on geographic risk, the state is now pricing individuals out of certain life choices based on statistical risk. If Robert's URS falls below a certain threshold, he might find that his interest rate on a car loan is 2% higher than his neighbor's. The state's argument is that an individual with an unstable domestic life is more likely to be an impulsive consumer and a higher risk for default. By monetizing this risk through the tax code, the government is attempting to nudge the entire American population toward low-risk, high-stability social behaviors. Consider the case study of a massive legislative battle that took place in early 2026 over the General Welfare Clause of the Constitution. Civil liberty groups argued that the URS violated the fundamental right to privacy and the freedom of association. However, the government's defense was centered on the concept of Pareto optimality. They argued that by reducing the frequency of divorce through financial disincentives, they were increasing the overall welfare of the nation. They presented data showing that children in high URS households had a 40% lower rate of interaction with the juvenile justice system. In the cold, utilitarian logic of 2026, the individual's right to an unmonitored relationship is secondary to the state's requirement for a predictable and taxable social structure. Imagine if your ability to pursue a promotion was tied to your spouse's behavior. In the URS system, this is exactly what happens. Because the score is a composite, any negative metric from one partner affects the other. If Robert's spouse is cited for a traffic violation or fails to pay a credit card bill on time, Robert's tax bracket could shift. This creates a state-sponsored form of domestic surveillance. The government has effectively turned every American citizen into a deputy underwriter for their own marriage. You are no longer just partners. You are co-managers of a state-regulated asset. This leads to the rise of what analysts call the relationship compliance industry. In 2026, companies are now offering URS optimization services. These are consultants who analyze your digital footprint and suggest behavioral changes to boost your score before you apply for a major loan or a government contract. They might suggest that you and your partner enroll in a state-approved conflict resolution seminar, or increase your contributions to a joint savings account, both of which are weighted positively by the URS algorithm. This is the ultimate monetization of risk. The government has created a market where the commodity being traded is your own social conformity. But the most profound impact of the social stability tax is the creation of a two-tiered society. We see a growing divide between the high URS elite and the unbondable underclass. Those with high scores enjoy lower taxes, cheaper credit, and better access to elite education for their children. Those with low scores are trapped in a cycle of high taxes and high interest rates, making it even harder for them to achieve the financial stability required to raise their score. The monetization of risk through the state has become a self-fulfilling prophecy, where the people the government claims to be protecting are the ones being most heavily penalized by the metrics. Historically, insurance was a way for a community to share the burden of a tragedy. In the nationalized model of 2026, insurance has become a way for the state to enforce a specific vision of the American family. We have moved from a society of rugged individualism to a society of algorithmic paternalism. The risk of divorce has not been eliminated. It has been absorbed into the very fabric of our civic identity. You cannot opt out of the social stability tax. You cannot hide from the URS. The only way to win is to be the most predictable version of yourself. As the government tightens its grip on the financial and legal aspects of our relationships, a new frontier of monetization is opening up. The state and the private sector have realized that even with all this data, they are still only looking at the external signs of a relationship. To truly eliminate the risk of divorce, they need to go deeper. They need to see what is happening inside the mind. We are about to witness the transition from behavioral monitoring to neurological intervention. In the next part, we will explore the terrifying emergence of the neural compatibility protocol. We will uncover how 2026 tech giants are partnering with the Department of Domestic Equilibrium to implement mandatory brain scans for couples seeking high-value marriage licenses. We will look at the rise of neuroalimony, where your thoughts themselves are being used as evidence of intentional emotional withdrawal. We are entering the world of the quantified soul, and the battle for the American family is about to move into the one place the government hasn't been able to reach until now. Get ready, because the next level of risk monetization isn't about your bank account. It's about your biology. The biological frontier of risk monetization is no longer a matter of science fiction, but the definitive regulatory standard in 2026. As the Department of Domestic Equilibrium realized that behavioral data, the GPS tracks and credit card swipes we explored in previous chapters, only offered a reactive look at a relationship, the industry pivoted toward the most granular source of truth available: the human brain. This is the era of bioactuarialism. In this framework, the risk of divorce is not just calculated by what you do, but by the neurochemical composition of your attraction. If the philosophy of the previous decade was about managing the fallout of a broken heart, the philosophy of 2026 is about quantifying the durability of the heart itself before it ever has the chance to break. Imagine Elena, a 34-year-old biostatistician living in San Francisco. Elena and her partner are applying for a Tier 1 marriage license, which grants them access to preferential interest rates on property and a significant reduction in their social stability tax. However, to qualify for this tier, they must submit to the Neural Compatibility Protocol, or NCP. This is a voluntary but economically coerced procedure where both individuals undergo high-resolution functional MRI scans while being exposed to sensory triggers related to their partner. The goal is to measure limbic resonance, the deep, nonverbal emotional connection that actuaries now believe is the ultimate predictor of long-term domestic stability. In this step-by-step process, Elena is placed in an fMRI machine while wearing a VR headset that displays images and videos of her partner, synchronized with the scent of their cologne and audio clips of their voice. The algorithm monitors the activation of the ventral tegmental area and the nucleus accumbens, the brain's reward centers. It measures the surge of oxytocin and dopamine in real time, but it also looks for the shadow of the risk, the activation of the amygdala and the anterior cingulate cortex, areas associated with fear, social rejection, and conflict. The potential outcomes of this scan are transcribed into a neurostability index, a subscore of the universal relationship score that we discussed in Part 8. For Elena, the results are a financial shock. While her behavioral data was impeccable, she and her partner have high joint savings and no history of conflict. The NCP reveals a dopamine divergence. The algorithm detects that Elena's reward response to her partner has plateaued over the last 24 months, while her partner's remains high. In the cold logic of bioactuarialism, this is the latent disengagement risk. The insurance underwriter sees this as a 42% increase in the probability of a no-fault filing within the next 5 to 7 years. Consequently, Elena's love premium is adjusted upward by 12%. She is effectively paying a surcharge for her own neurological cooling. This leads to the rise of the most controversial legal concept of 2026, neuroalimony. Historically, alimony was based on financial disparity, but in a world where we can quantify emotional labor, a new trend is emerging in American family courts. Imagine a case study where a spouse is sued for intentional emotional withdrawal. In this scenario, the plaintiff uses historical data from the defendant's wearable neurotrackers to prove that the defendant stopped investing in the emotional bond years before the physical separation occurred. The argument is that the defendant allowed a valuable social asset, the marriage, to depreciate through biological neglect. Step by step, The court reviews the neurotransmitter baselines recorded by the couple's mandatory wellness rings over a 3-year period. If the data shows a sustained drop in oxytocin production during shared activities, the court may rule that a biological breach of contract has occurred. This isn't just about hurt feelings. It is about the monetization of the unrealized emotional yield of the relationship. The settlement is no longer just a split of the house and the 401k. It includes a restorative levy to compensate the abandoned spouse for the years they spent tethered to a neurologically disengaged partner. The philosophy of monetizing biological risk has also birthed a new asset class on Wall Street: neurostability bonds. These are complex derivatives backed by the collective NCP scores of a specific demographic or geographic region. Investors are essentially betting on the biological resilience of the American population. If a city like Austin shows a high aggregate limbic resonance score, the bonds associated with that city's social stability tax revenue are considered AAA rated. However, if a region shows a spike in cortisol-related domestic volatility, the bonds are downgraded, leading to an immediate increase in the local social stability tax to offset the projected casualty claims. We must also consider the quantified soul movement that has emerged as a response to this. Some Americans are now taking neurosupplementation, specifically to game the NCP scans. There is a booming black market for oxytocin inhalers and dopamine-regulating peptides, designed to be used in the 48 hours leading up to a government or insurance audit. This creates a biological arms race. The Department of Domestic Equilibrium responds by implementing random neurostresses into the testing protocol to see if the reaction is authentic or chemically induced. We have moved from faking a smile in a wedding photo to faking a neurotransmitter surge in an fMRI tube. The macroeconomic implications are profound. By 2026, the cost of human connection has been fully internalized into the price of the American lifestyle. The risk of love is no longer an abstract poetic concept. It is a line item on a balance sheet. We see a historical trend where the marriage rate among the bottom 30% of the URS bracket has plummeted to near zero. Not because people don't want to be together, but because they simply cannot afford the biological insurance premiums required to make the union legal. The state has effectively privatized and biologicalized the right to a family. Consider the imagine-if scenario where your job performance is linked to your limbic resonance. In 2026, some high-stress industries like neurosurgery or aerospace engineering require employees to maintain a certain URS and NCP score. The philosophy is that an individual in a state of neurological domestic crisis is a liability in the workplace. If your brain scan shows a high conflict trigger response at home, your employer's insurance company might require you to take a mandatory relationship sabbatical or face a suspension of your professional license. Your brain's inability to maintain a stable connection with your partner is now viewed as a pre-existing condition for professional failure. This is the ultimate expression of the monetization of risk. We have stripped away the mystery of the human heart and replaced it with an actuarial table. We have turned the most intimate biological processes into taxable, insurable, and tradable commodities. The American dream in 2026 is no longer about finding the one. It is about finding the one whose brain state creates the lowest possible fiscal liability for your future. But as the system reaches this level of absolute control, it begins to create its own noise. In the final part of this documentary, we will look at the great calibration of late 2026, a moment where the algorithms, the taxes, and the neuroscans finally push the American public to the breaking point. We will explore the systemic divorce, where millions of Americans simultaneously opted out of the monitored economy, and how the collapse of the divorce insurance industry nearly took the entire U.S. banking system with it. We are approaching the end of the deep dive, and the conclusion will force you to decide. Is a managed life worth the price of a monitored soul? In the next part, we will witness the actuarial apocalypse. We will uncover the zero URS movement and the radical shift toward post-risk relationships. This is the finale of the philosophy of monetizing heartbreak, and it ends with a question that the algorithms can't answer. The actuarial apocalypse of late 2026 did not begin with a stock market crash or a political coup, but with a silent, synchronized deletion of data. For years, the American middle class had been squeezed into the narrow corridors of the universal relationship score, their every neurochemical surge and credit card swipe monitored to manage the risk of domestic failure. But by the fourth quarter of 2026, the system reached its point of maximum tension. The philosophy of monetizing risk had become so efficient that it stripped away the very thing it was trying to protect: the human capacity for spontaneous, unmonitored connection. This was the catalyst for the Zero URS movement, a radical social shift that saw millions of citizens intentionally sabotaging their own stability metrics to reclaim their privacy. Imagine Thomas, a 48-year-old data architect living in the suburbs of Virginia. Thomas had spent his entire career building the very algorithms that now dictated his tax bracket and his custody schedule. In November 2026, Thomas reached his breaking point. He realized that his marriage had become a performance for an invisible audience of underwriters. Every date night was a calculated move to boost his limbic resonance score. Every shared expense was a tactical maneuver to avoid an audit. Thomas did what many thought was impossible. He initiated the blackout protocol. Step by step, Thomas used decentralized tools to scrub his digital twin. He disabled his wellness trackers, closed his synchronized bank accounts, and intentionally engaged in low-velocity, erratic behaviors designed to confuse the Department of Domestic Equilibrium. Thomas was not alone. Historical trends show that when a system becomes too rigid, it creates a counterculture of radical unpredictability. Within weeks, the Zero URS movement spread across the United States. People were no longer afraid of a low score. They began to wear it as a badge of honor. They called themselves the Unbondables. By intentionally tanking their scores to the 300-level baseline, they effectively opted out of the monitored economy. They traded the benefits of high-tier marriage licenses, the low interest rates and the tax breaks, for the freedom to live without a digital shadow. This was the first stage of the systemic divorce, the mass decoupling of the American public from the financial machine that had monetized their heartbreak. The economic fallout was immediate and catastrophic for the insurance industry. To understand why, we have to look at the mechanics of the alimony-backed securities and child support futures that had become the darlings of Wall Street. These bonds were only valuable because they were perceived as low-risk, high-certainty assets. Investors believed that the surveillance of the URS system would ensure that payments were made and that careers were optimized. But when millions of people like Thomas went dark, the underlying data for these bonds vanished. Investors were suddenly holding billions of dollars in debt, with no way to track the collateral. In December 2026, we witnessed the first flash divorce event. An algorithmic trading bot, detecting a sudden spike in untraceable social interactions in the Pacific Northwest, triggered a massive sell-off of regional social stability bonds. This created a domino effect. As the value of the bonds plummeted, the insurance companies that issued them faced a liquidity crisis. They no longer had the capital to pay out the transition benefits for the very divorces they were supposed to manage. The monetization of risk had created a bubble, and that bubble was built on the false assumption that human behavior could be perfectly predicted. When the unpredictability returned, the bubble burst. The step-by-step collapse of the divorce insurance complex followed a predictable pattern of financial contagion. First, the secondary markets for career equity stopped trading altogether. Then the private mediation platforms, which relied on insurance payouts to function, began to shudder. Finally, the state-run National Family Resilience Fund faced a multi-trillion-dollar deficit as tax revenues from the Social Stability Tax evaporated. The government had banked on a society of compliant, high-score citizens. They were unprepared for a nation of unbondables. This brings us to the rise of post-risk relationships. As the formal systems of 2026 crumbled, a new philosophy began to take root in the ruins. People were moving away from the idea of insurance and back to the idea of trust, but with a 21st century twist. We saw the emergence of analog intimacy hubs, communities where digital surveillance was physically blocked, and where social contracts were based on face-to-face accountability rather than algorithmic oversight. In these communities, the risk of divorce was not hedged or traded. It was simply accepted as a part of the human condition. Case studies from this period show a fascinating trend. While the official divorce rate appeared to skyrocket due to the lack of preventative insurance interventions, the actual satisfaction scores of these off-grid couples began to climb for the first time in a decade. By removing the financial incentives to stay together and the financial safety nets for leaving, the movement forced individuals to confront the reality of their relationships. Without an insurance check waiting on the other side, the decision to stay or go became a purely personal one again. The monetization of risk had accidentally proven that when you remove the risk from love, you also remove the value. Imagine if we lived in a world where the most significant choice of your life, who you love and how you live with them, was once again a mystery. In late 2026, that mystery returned with a vengeance. The Great Calibration had failed because it tried to turn a chaotic biological process into a linear financial one. The philosophy of monetizing heartbreak was ultimately defeated by the one thing the algorithms could never account for: the black swan of the human spirit. A black swan is an event that is impossible to predict, has a major impact, and is rationalized in hindsight as having been avoidable. Love in its truest form is the ultimate black swan. We have spent 10 parts exploring the deep dive into this world of data, insurance, and surveillance. We have seen how the American family was dismantled and rebuilt as a financial franchise. We have watched as children became collateral and careers became equity. But as we stand at the edge of 2027, the lesson is clear. You can monetize the fallout of a relationship, you can hedge against the costs of a legal battle, and you can even track the neurochemicals of attraction. But you cannot insure against the fundamental uncertainty of another human being. The final question that the algorithms can't answer is not about probability or yield or tax brackets. It is a question of value. What is a relationship worth if it is perfectly safe? What is a heart worth if it is fully insured? As the systems of 2026 continue to recalibrate and the fight between the state and the unbondables intensifies, the American public is left with a choice. We can choose the security of the monitored life, where our risks are managed but our souls are quantified. Or we can choose the volatility of the unmonitored life, where heartbreak is a real possibility, but so is real connection. The philosophy of monetizing risk was the ultimate attempt to conquer the fear of loss. But in trying to eliminate the pain of the end, we nearly eliminated the joy of the beginning. As we look toward the future, the only certainty is that the human heart will continue to defy the spreadsheets. The deep dive into the divorce industry has revealed that the greatest risk of all isn't the failure of a marriage. It's the success of a system that treats a marriage like a car loan. This documentary has explored the machinery of that system, but the final chapter isn't written in code or in contracts. It is being written right now, in the private, untracked, and beautifully unpredictable choices of people who are deciding that some risks are not meant to be hedged. They are meant to be lived.